Every investor fears this exact moment. Everything seems normal. The markets are up. Nothing screams panic. In fact, you're probably not even paying attention. In February 2020, that's where I was. But a system that I built years earlier didn't allow me to wait for confirmation. It told me to liquidate now. After nearly a decade of running an AI-assisted decision system on a public portfolio, here's exactly what I've learned. The hardest decisions in investing happen before they feel obvious. I'm Heloise. I run a public portfolio on eToro that's been live since 2016 with over 250,000 followers watching in real time. One moment made that lesson painfully clear. But to understand what happened in 20, you need to understand the mistake I consistently made in 2016 that forced me to build that system in the first place. In 2016, I was deep into my PhD, studying complex systems under stressful conditions. I was in a field of machine learning trained in Bayesian methods. That's a fancy way of saying I was trained to think in probabilities, not certainties. When you think in probabilities, investing looks different. You stop asking what will happen and start asking what could happen and how do I protect myself from the worst while staying exposed to the best. So I built an AI system to answer one question. What is the risk reward right now? Should I be in or should I be out? Simple, probabilistic, and most importantly, unemotional. In 2016, I kept watching myself making the same behavioral mistake over and over, even though I knew to be better. That's when I realized the constraint wasn't the information. The internet made that very accessible, but the constraint was me. When February 2020 came around, I was ready, or at least the system was. I remember vividly being out for brunch in Oxford. Markets were at an all-time high. No one was worried. When I got home, I checked my models. Warning flags went off, not because of COVID-19, that barely registered, but because the risk reward that I was tracking had shifted in ways that many people weren't tracking. But I felt doubt. Maybe it's overreacting. Maybe wait one more week. Maybe the news will catch up and give more certainty. The AI wasn't emotional. It was probabilistic. It was calmly saying, risk no longer justify this exposure, exit now. So I liquidated a substantial part of my portfolio, not because I knew something was coming, but because I had pre-committed to a system that would inform me in moments exactly like this uncertainty. And this was the exact moment where I learned the difference between knowing something intellectually and having a system that forces you to act on it. And sure enough, 3 weeks later, March 2020 happened. The system didn't predict that would happen, but it protected me from the part of me that would have stayed invested just in case. Although it's a really powerful decision support tool, we are still negotiating where those boundaries are. So over the last 10 years of using AI as part of my investing system, here's what I've learned. AI doesn't make me better at being a stock picker. It makes me better at being a decision protector. That's where I still see AI play the most powerful role in investing. It's helping you to become more efficient at portfolio management by effectively reducing the number of wrong decisions that you make. In my case, it's not automated. It's not making trades while I sleep. There's very much still a human in the loop, but it's an incredibly powerful decision support tool that protects me from overriding my own investing hypothesis when emotions start to play a role. In one of my previous videos, I talked about the knowing-doing gap. It's the distance between what we know we should do and what we actually do when greed or fear kicks in. And for the last decade, I've been watching how AI affects that gap. Here's what I found. During news spikes, it forces me to go back to the process and away from the news feed. During winning streaks, it has stopped me from trying to do just that little bit more to improve the system and get my ego out of the room. And during drawdowns, it makes inaction feel like a decision without being a failure. So here's what I need you to understand. AI didn't remove the emotional cost of investing. I still felt every drawdown in my portfolio. The difference is that I stopped acting on those emotions. I'll share with you the single biggest risk of using AI in investing that nobody's talking about. But before that, I need you to understand what AI is good at and what it isn't good at. I have found AI really useful for reading through large amounts of documents that I'm too impatient to cover. It's useful for surfacing patterns that I have dismissed because of recency bias. It's really useful for enforcing discipline when I just wanted to try something. Here's what it's not good at. It's not good at predicting the future. It's also not good at removing uncertainty. It just quantifies it in a way that is different. And it also doesn't make losses feel more comfortable. You still feel them very much. But here's the risk no one talks about. AI has a real danger of making investors overconfident at the wrong moment. So why am I only talking about this now? In the last year, I've watched people blow up their portfolios by using AI. It wasn't the AI. They didn't understand what AI can't do. I realized I have 10 years of data on this. It's probably a good time to share it. Back in 2016, talking about AI in investing meant either robo-advisors or hype, and both were wrong. When I reflect on my lived experience of what happens when you combine systematic tools with behavioral awareness, the answer shocks a lot of people. A lot of people are wanting me to say it's deep learning, it's reinforcement learning, but it's not actually about the technology. This matters whether you are managing your own portfolio or you're thinking about how to structure a portfolio for other decision makers. The constraints aren't computational, they are still human. Over the next few weeks, I'm going to be breaking this down through the behavioral finance lens we've been building. And over the coming episodes, I will look at what AI is good at investing and what it won't do, why AI doesn't solve the behavioral problem for investors, where AI actually introduces more risk into your portfolio if you're not careful, and how I review my decisions without changing them. I'll show you the moment in 2022 when I overrode the AI decision, because knowing when to trust the system versus your own judgment is where most people fail right now. I want to help you build a structure that feels natural without taking unnecessary risks. And AI, that's just one tool within your decision-making structure. Here's what 10 years of applying AI taught me. The AI doesn't make me smarter, it makes me more consistent. Not better predictions, not better behavior. So in next week's video, I'll show you exactly where the AI flagged risk and why I ignored it. So if you don't want to miss it, make sure to subscribe. And I'd love to hear from you in the comments. Where do you sabotage yourself the most right now? Is it during hypes, during the drawdown, or is it just during the boring periods? Let me know.